Vinod Karki is joining us to discuss more about markets. Vinod, talk to us about how are you analyzing the valuation picture right now. There's a reasonable amount of correction which has already played out. How are things looking as we stand?
Hi Ajay, I hope you can hear me.
Very well. Please go ahead.
Yeah, so valuation picture is pretty clear. If you see October of 21, where we started getting the first fear of the quantitative tightening cycle. At that point, if you just look back, the the P ratio for the Nifty 50 was around 23x forward, and right through that, from that point till now, we are sub 19. So obviously the valuation expansion that we have been seeing for quite a few years, that has started to reverse. And we feel it will continue to reverse till the time the quantitative tightening doesn't end, basically. So that will be the thing. And within the market, I mean, that's the headline. But if you look at the very expensive stocks, the ones which are like 30, 40, 50, even 70, 80 PE, that is where the maximum valuation contraction will be seen, because that's way above their long-term averages and gets into high optimism zone. Whereas we know that growth is weakening a bit. So there are growth challenges and valuation contraction due to the quantitative tightening cycle. Both, I think, will impact the very high optimism stocks where valuations are pretty high.
Vinod, let's look at the kind of earnings quality which were delivered in the third quarter to understand where does the cushion for this correction lie. If you stress test your hypothesis on the numbers front, how much further fall in the market, just for indicative purposes, because historically at what valuations have we bottomed out, barring the COVID low, because that was a one-off. One can understand that, is it a time to deploy into the market next 6-12 months with a 2 to 3 year view?
Yeah, so if you look at really long-term perspective, then there is more way to go. I mean, that's been the 15, 16 PE kind of number has been the average. But what we have observed is, right, I mean, from 2014, 15 onwards, the market has not dipped below, the 17, 18 times kind of number overall. So, and that's got to do with, I think, the composition of the index also, that more of these less capital intensive, expensive kind of stocks, which are in the services, consumption and all, making up quite a bit of the overall index. But I mean, if you start moving into an environment where the investment cycle and the corporate credit cycle picks up, you will be seeing more companies maybe which are reasonably valued getting into the index, and therefore also helping valuations. But broadly, what's happening is some of these high valuation pockets are seeing growth challenges. Whereas some of the reasonably valued sectors, which are in the capital intensive sector or the corporate lending kind of environment, they are reasonably valued overall. So where the growth is showing up, look at the broader economy or the companies in the economy, it's the capital intensive companies which are showing better growth, and even the prospects of growth are better. And the valuations are not as lofty as in the other side of the market. So I think that's where we would lean towards in these markets where growth is better and valuations are reasonable.
Vinod, you also make a point that with this correction, valuations, of course, have come down, and now you are kind of confident that next 12 months, 12% kind of returns, it's reasonable to expect that kind of returns. Can you expand that argument for us?
Yeah, so see, what we have seen is that the long-term expected return from the index has been around 12%. And that you can expect only when you have, normal valuations, not very high valuations. From very high valuations, the expected returns start dipping. So as I said, say from October 21, when we were at around 23x, now way below 19x right now. And the growth being, the earnings growth expectations are still not very bad. I mean, they are in the mid-teens, I would say. And that's not unfair because the nominal GDP itself will grow at double digit nominal terms. So, and a lot of stress in terms of NPA cycle and some of the industrial companies which had a lot of stress in terms of profit pool shrinking. That's been reversing over the last couple of years. So I think, I mean, from these levels, expecting a 12% kind of a return is not very high of, optimism, I would say. But that also depends on whether this quantitative tightening cycle is nearing its end, which I believe it is, because the way some of these high frequency indicators are moving in terms of inflation trajectory, I think we are towards the end. Obviously, it's not the end. There will be some more hikes, but by the end of this year, we'll be looking at rates, declining or stagnating. So that will help in valuations not contracting further.
Fair point. So valuation may trough out. I want to understand from you, Vinod, that today there's an emergency Fed meet. What are your expectations on the commentary front, and in your hypothesis, how many further rate hikes are you penciling in, both in the US and back home in India as well?
So, as the Fed chair has himself said, that all these decisions will be determined on the basis of incoming data. So, the most important data that we'll be having is the CPI data in the US tomorrow, and depending on that, I mean, if you see the last data, the wage inflation was a little weaker, although the job market in the US was pretty resilient overall, although there was some increase in the unemployment rate. But point is, there are some mixed data which is coming in, and the capital markets are already giving you signals that this very sharp increase that the central banks have undertaken over the last year or so can break something in global capital markets. So I think that will play on the mind of the central bankers globally. That because see, these rate hikes that you do, their transmission takes time, right? So it's not as if these rate hikes have all been absorbed by the economy. So it's plausible to think that the central banks will slow down in terms of in the RBI minutes. Also, we saw some kind of divergence in views that should we continue with this rate hike. So I think that we have reached a point where there is some merit to the other side of the discussion, that we should not be increasing it too high so that it breaks something in the capital markets, which will have a very sharp repercussion for the overall economy. So I think that doubt is already there now for the central banks to ponder upon. So I think that we feel that the rate hikes will slow down as we go ahead from this point onwards.
Right. Vinod, one last question I want to understand is, what are your expectations from Fed as well as back home in India with RBI on rate hike front? Also, what is Street penciling in? Because the discounting on valuation will actually be forward discounting, and there is a view that India may see lower rate hike even if US Fed goes ahead and hikes rate by 3 times. So, want to understand where will market already start pricing in peaking out of rates?
So I think market is already to some extent, penciling in, discounting 50 bips from the US Fed, which I think is still not a done deal. I mean, going by the Fed chair's words himself, I mean, he will be looking at. So if suddenly tomorrow the data on CPI is not very high, so that, and what happened to SVB, that will play on the mind of the central bank. Central bank. So I think there are enough doubts right now to say that 50 bips, which is being discounted by the market, may not happen. And if that happens, then equity markets will ease a bit, in my view, the kind of volatility that we have been seeing. So I think my view is that we will not see aggressive rate hikes from the Fed, because you have to remember that this event which has happened is already tightening the financial markets, which the central banks want. I mean, their rate hikes is about tightening the financial markets, and these events have already tightened the market to some extent, in my view. So, so some of the work has been done by the capital markets themselves. So I think that will play on the mind of these central bank heads, and I think you should see relatively lower aggressiveness in terms of rate hikes going forward.
Right. All right, Vinod, we'll let you go on that one. Thanks so much for joining us with your thoughts today.